Welcome to the Deep Dive. Today we're looking at Cholamandalam Investment and Finance Company, or CIFCL, a real giant in India's NBFC sector. Our mission is to give you the essentials. Is the decadal growth idea solid? What's their real competitive edge? And is this Murugappas group company a smart long-term bet for you?
Yeah, and we hit a key question right away. Is this a genuine blue chip, a buy and hold forever type compounder, or is it just a very good company that's currently, let's say, priced for perfection? I mean, the scale is huge. Their assets under management, the AUM, was what, 1,084,746 CR at the end of FY25? Massive.
Okay, let's unpack that. Why do people rate this company so highly? Let's talk about their competitive mode. It seems like there are two parts to it.
That's right. Two key pillars. First, you've got that Murugappas group connection, the synergy there.
And what does that actually do for them?
Well, it's invaluable, really. It's more than just a name. It gives them instant credibility, a kind of trust factor. And more practically, it lowers their cost of funds significantly.
Okay, so that implied backing helps their borrowing costs.
Yeah, exactly. And just as important, it fosters this deeply conservative risk culture within the management team. That's a huge intangible benefit.
So the group backing provides a safety net. But how do they actually compete day to day? You mentioned this phygital network idea.
Yes, the phygital approach. This is where it gets really interesting. They have this enormous physical presence, right? Over 1,600 branches, 1,613 to be exact. But here's the clever bit. 92% of those branches are in Tier 3 to Tier 6 towns, smaller towns and rural areas.
92%. Wow, so they're really embedded in those underserved areas.
Deeply embedded. And that boots on the ground network is incredibly difficult for, say, a pure digital fintech player to replicate.
Why is that?
Because in many of these areas, formal credit data, digital footprints, they're just not there. CICL uses its local presence, its people for underwriting and verification. It's how they serve, over 4.3 million customers that newer players just can't easily reach.
Okay, so the bull case then seems pretty straightforward. CIFCL benefits directly as India grows. More vehicles needed, more small businesses needing credit, more affordable housing.
Precisely. It's a direct play on those big structural trends. But like any compelling story, there's usually a twist. Or in this case, maybe a warning sign.
A red flag. Let's get into that. What happened?
Well, that conservative culture we talked about, it got tested. They saw some significant issues, real underwriting failures in their newer consumer and small enterprise loans segment. CSCL, they call it?
CSCL. Wasn't that their move into unsecured loans, partnering with fintechs?
That's the one. Personal loans, small business loans, often unsecured. And that book, driven by those fintech partnerships, grew really fast. Maybe too fast. It reached about RS 7,000 CR.
Hold on. If they're supposed to be so conservative, backed by Murugappas, how did they let a risky book like that get so big? Were they chasing growth too hard?
That seems to be the paradox, doesn't it? They reached for higher growth, perhaps got a bit ahead of themselves, and, well, it backfired. But to give management credit, they acted decisively. They made a conscious call, as they put it, to just exit that high-risk CSCL book completely.
Completely exit. Wow. That must have hurt in the short term.
Oh, it did. Big time. It led directly to a massive 52% year-on-year jump in their loan loss provisions in the first quarter of this financial year, Q1 FY26. That was RS 8882 CR in losses versus RS 581 CR the year before, a huge spike. But it showed they were willing to take the pain immediately to clean things up for the long run.
A 52% spike.
Yeah.
Yeah, that's taking your medicine. Demonstrates discipline, I suppose, even through a misstep.
Absolutely. But that CSCL issue isn't the only pressure point right now. We're also seeing some deterioration in their core portfolio.
What kind of deteriorate?
Their gross stage 3 NPAs, these are the seriously overdue loans they've ticked up, reached 3.16% in that same first quarter, Q1 FY26. And part of that seems linked to stress in their main vehicle finance segment, possibly due to slower demand in rural areas.
Okay, so CSCL exit pain plus some stress in the core business. What does that do to the whole growth story? That 30% plus growth they used to talk about, that's surely off the table now.
Yeah, that era looks to be over. The new normal, the guidance they're giving, points towards a more, let's say, sustainable and prudent growth path. Think 18-20% earnings growth compounding. Still good, but not spectacular.
Right. 18-20% is still solid growth, but then the question becomes the valuation, doesn't it?
Exactly. That's the crux of it now. Is the current valuation justified given this moderated growth outlook? The stock trades at a price-to-earnings ratio, a PE of around 32.4x.
Yeah, 2.4 times earnings.
And the price-to-book?
Price-to-book is also quite high, about 6.8x.
So what does that PE of over 32 really tell us, especially now? It tells you you're paying a very significant premium, 32 times this year's expected earnings, for a company that's guiding for maybe 22% AUM growth going forward, and importantly, also guiding for higher credit costs. They expect credit costs to be around 1.4, 1.5%. So you have moderated growth and elevated costs, yet the stock price seems to imply, well, perfection. It feels like the market might be overlooking some of these recent stresses.
So summing it up, the underlying business quality seems excellent, almost lifetime quality, thanks to that strong moat and the management's proven conservatism, even if they stumbled with CCL. But the stock itself, that carries significant valuation risk right now, paying too much for good, but not stellar growth.
That's a fair assessment. The business is strong, the price looks demanding. And here's a final thought for you to consider. The CSCL failure, while painful, ultimately showed management can be prudent and manage risk long term. But now, they're pivoting into gold loans. That's a notoriously competitive market full of specialized players. Given the execution fumble we saw with CSEO, how much risk should you factor in for this next big diversification move? That's the question mark hanging over CIFCL now.